It's Tuesday morning. You're in line at your bank. The doors are open. The lights are on. But the teller's smile is wrong. Not good morning, wrong. More like, please don't ask questions, wrong, because the screen behind her says one word, unavailable. Not forever. Just for now. Just temporary. Just long enough to ruin you. Now picture this. You walk back to your car. You turn on the radio. They're calm. They're joking. They're telling you everything is fine. Markets are functioning normally. And then you see the chart. Silver prints. 73.39E. For a moment, it looks like a glitch, a typo, a ghost trade. Then, whiplash, up, down, violent, like a fishing line when a shark hits the bait, and you feel it in your stomach, because that wasn't healthy price discovery. That was a scream. That was a panic cough in a quiet room. That was forced selling. Stops getting harvested like wheat. And here's the part that should freeze your blood. If silver can do that in seconds, in plain sight, what do you think they can do to your retirement account? Your pension, your bank deposits, your safe money market fund. They trained people for decades to believe the system is sturdy, that the rules are fixed, that your savings are protected. They trained you to relax, to outsource your safety, to trust the badge, the suits, the agencies, the acronyms. And the moment you trust them, they have you. Because the system was never built to protect you. It was built to protect itself. And when it starts cracking, they don't save the sleeping herd. They save the people closest to the exits, the insiders, the institutions, the ones who get the phone call before the headline. If you're still trusting the television, you're already late, because that was 73.39. Print wasn't a celebration. It was a symptom, a tremor. And tremors come before the collapse. Now let's talk about what that whipsaw really means. It means liquidity is thinner than they admit. It means the market is fragile, over-leveraged, like a casino built on toothpicks. Most people think silver is silver. A bar is a bar. A coin is a coin. Wrong. There are two silvers, paper silver and physical silver. Paper silver is promises, contracts, IOUs stacked on IOUs. Physical silver is metal, weight, a thing you can hold in your palm and feel the cold of it. Paper gets traded like confetti. Physical gets bought and disappears. And when you see a freak print like 73.39, followed by a whip back, that's what stress looks like. That's what forced liquidation looks like. Here's the mechanism, plain and ugly. A big trader gets overextended. Maybe they're long, maybe they're short, maybe they're hedging. That word they use when they don't want you asking questions. Then margin requirements change, rates rise, collateral gets tight, a lender makes the call, post more cash, now, not tomorrow, not when you can, now. So what happens? They sell what they can, not what they want to, what they can. That's liquidation. It's not emotional, it's mechanical. And mechanical selling doesn't care about price, it cares about survival. That's how you get insane prints. That's how you get violent candles. That's how you get whipsaws that make honest people nauseous. Now widen the lens, because silver isn't the problem. Silver is the smoke. The real fire is the debt system. Your government runs on debt. Your banks run on debt. Your pensions run on debt. Your safe funds run on debt. And debt has a heartbeat. Interest. When interest rates rise, debt becomes a noose. And the noose doesn't tighten all at once. It tightens quietly, quarter by quarter, bill by bill, until one day the chair kicks out. Let's do the math they refuse to say out loud. If a country is carrying tens of trillions in debt, and the average interest cost creeps higher, each single percentage point becomes a monster. 1% on 30 trillion is 300 billion a year, not once, every year. And if your interest burden climbs to numbers that look normal in history, you're staring at hundreds of billions, even trillions, just to pay the interest, not the principal, just the interest. That means one thing, they cannot pay it honestly, so they pay it the old way. They print, they inflate, they dilute. And inflation is theft with a suit on. It doesn't rob you in an alley, it robs you at the grocery store, it robs you at the gas pump, it robs you when your insurance renewal arrives. It robs you when your property tax jumps slowly, quietly, while you're busy living. Your groceries rise, your heating bill rises, your medication goes up. The car repair that used to cost a few hundred suddenly costs 1,000. But your savings, they don't rise, they rot. That's why silver matters. Because silver is one of the few things in this world that doesn't need permission to exist. No CEO signature, no bank approval, no government guarantee, just metal. Now let's talk about the safety nets. Because every retiree gets sold the same bedtime story. Your deposits are insured. Your system is stable. Your retirement is safe. Listen carefully. Insurance is only as good as the insurer, and the insurer is the same system that's drowning in debt. If enough banks wobble at the same time, if enough depositors reach for the door at the same time, the insurance turns into a ration card, a delay, a process, a line, a form, a promise. And you can't pay rent with a promise. You can't buy food with a promise. You can't refill a prescription with a promise. And here's the sentence that should stick to your ribs. In a real crisis, they don't run out of money. They run out of trust. When trust dies, everything dies. Banks are confidence. Markets are confidence. Pensions are confidence. And that freak silver print, 73, 39 eyes, followed by a whipsaw, that was confidence shaking. That was the system showing you its teeth. Now I'm going to say it, and I need you to hear it like a warning siren. This isn't a theory, this is math. Debt plus high interest plus endless promises equals one ending. They will change the rules, and when they do, they will not ask you. Now we step into the next room, the room nobody wants to look at because it smells like control. You've heard the term CBDC, central bank digital currency, a dollar that lives inside a government-controlled ledger, not a bill in your wallet, not cash in your drawer, a permission slip, a switch, a leash, and they'll sell it to you like it's convenience. Fast payments, less fraud, modern money. But the real reason is darker, because the current system is leaking. People are waking up. People are hoarding cash. People are buying hard assets. People are moving money out of the approved pipelines. A CBDC fixes that. With a CBDC, they can freeze accounts, limit withdrawals, track every purchase, set spending rules. And the scariest part? They can program it. Imagine this. Your digital dollars expire if you don't spend them, so you can't save. Imagine this. You try to withdraw a large amount. The app says review required. You call, you wait, you get transferred, you get put on hold. And the answer is always the same, temporary. Imagine this. You donate to the wrong group. You post the wrong opinion. You support the wrong cause. And suddenly you're flagged, not criminally, administratively. No court, no jury, just a quiet limit placed on your life. Imagine this, a climate emergency, a public safety event, a financial stabilization period, and then suddenly you can't buy gas on certain days, or you can't spend above a certain limit, or your funds are temporarily restricted, all legal, all for your protection. The sleeping herd will clap because the herd loves safety, even when safety is a cage. Now let's talk about confiscation. People hear that word and roll their eyes. Not here, not now. They can't. History laughs at that sentence. Rules change when governments panic. They don't confiscate because they want to. They confiscate because they must, because the math doesn't work. And when the math doesn't work, they look for assets they can grab. They look for pools of money they can tap, retirement accounts, pensions, bank deposits. And they don't call it confiscation. They call it emergency measures. They call it stability tools. They call it temporary policies. They call it fairness. Words are masks. Now listen, this is where it gets personal, because you're not 25. You don't have 40 years to recover. You worked, you saved, you played by the rules, and the system is about to punish you for being responsible. Future pacing time. Imagine this. You wake up and your bank app works, but withdrawals are capped. You can only take out a little per week. You're told, don't worry, it's temporary. Temporary becomes normal. Normal becomes permanent. Imagine this. A letter arrives about your pension. Due to market conditions, adjustments have been made. That means you get less, and inflation keeps eating, so you lose twice. Imagine this. Your safe bond fund doesn't feel safe anymore because bonds don't protect you from inflation. They protect the borrower, and you're not the borrower. You're the lender. You're lending to a system that can't pay honestly. Imagine this. You go to a dealership ready to buy a used car. The price is insane. You ask why. They shrug and say, that's just the market. No, that's not the market. That's your currency collapsing in slow motion. Now back to silver. Why did silver print 73, 39 and whip back? Because in a stress system, prices don't move like a staircase. They move like an elevator with cut cables because big players don't trade. They trigger. They hunt stops. They shake weak hands. They smash liquidity. They know where the herd places their orders. And when they need cash, they don't negotiate with you. They run you over. That's the trap. A paper market built for speed. Trying to price a physical asset built for permanence. It's like trying to measure an anchor with a feather. When panic hits, paper games break. And when paper games break, they change the rules. Halts, limits, settlement changes, cash settlement. And if you're holding silver exposure on a screen, you may not get silver. You may get a check in a currency that's melting. That's not protection. That's a joke. So what do? You stop thinking like a trader. You start thinking like a survivor, because this isn't about getting rich. It's about not getting wiped out. Physical gold and physical silver are not just investments. They are survival. They are freedom. They are bearer assets. And a bearer asset is simple. If you hold it, you own it. No counterparty, no middleman, no permission. Now we need to talk about a phrase Wall Street hates: counterparty risk. It's the risk that the other side of the promise can't pay. Your bank deposit, counterparty risk. Your pension fund, counterparty risk. Your ETF, counterparty risk. Your broker, counterparty risk. Even your insured cash, counterparty risk, because it depends on systems functioning under stress. Physical metal, no counterparty. A silver coin doesn't go bankrupt. A gold bar doesn't need a bailout. A stack of metal doesn't care what the Fed says. It doesn't need faith. It just is. Now let's use a metaphor you can feel. The Titanic didn't sink because people didn't have money. It sank because the lifeboats were limited, and the lifeboats weren't handed out fairly. They were handed out to the connected, the close, the quick. Silver and gold are lifeboats. Not because they make you a genius, because they make you harder to kill financially. Now the obvious question, why silver? Because silver is money. And silver is an industrial necessity. It's used up, consumed, not just stored. And when the world gets unstable, two things happen at once. People want money they can hold, and industries still need what they need. So silver sits at the crossroads like a toll booth. But here's the trick. They don't want you owning physical. They want you owning paper, because paper can be diluted. Paper can be rehypothecated. Paper can be settled in cash. Paper can be controlled. Physical can't. That's why when the market spasms and you see insane prints like $73, $39, you shouldn't be thinking, how do I trade this? You should be thinking, what does this reveal? It reveals liquidity is fake. It reveals leverage is huge. It reveals somebody big is trapped, and trapped animals bite. Now let's talk about being your own central bank, because that's the mindset shift. A central bank prints. A central bank controls the currency. You can't print, but you can control your exposure. You can store value outside the system. You can own assets that don't depend on someone else's promise. That's what being your own central bank means. It means you don't outsource your financial life to institutions that change the rules mid-game. It means you keep a portion of your savings in a form that cannot be frozen with a keystroke. Now get practical. This isn't about taking wild risks. This is about balance, redundancy, about not being the person who has everything in one bucket when that bucket has a hole. Because here's what retirees don't get told. In the next crisis, the pain won't be shared equally. The system will pick winners, and you are not on their list. So you build your own list. You build your own safety net, and that safety net is made of things that don't lie. Metal, land, useful goods, skills. But metal is the simplest start because it's portable. You can move it, hide it, hand it to your kids. It doesn't need Wi-Fi. Now a warning. When panic goes mainstream, premiums explode, supply dries up, and the herd rushes in late, like always. They'll say, I'll get some next week. Next week becomes out of stock. Next week becomes limit 2 per customer. Next week becomes delivery delayed. Because when the herd wakes up, it wakes up all at once, and the awakened few are already positioned. That's the us versus them line. It isn't political, it's psychological. The sleeping herd trusts headlines. The awakened few watch behavior. Headlines say, stable. Silver screams, stress. Headlines say, soft landing. Debt screams, no landing. Headlines say, inflation is easing. Your grocery receipt screams, liar. So here's the move. You prepare before the stampede, not after. And yes, some of you are thinking, isn't this extreme? Let me answer you plainly. Extreme is being 65 years old with your life savings trapped behind a screen during a systemic freeze. Extreme is watching prices double while your income stays flat. Extreme is trusting institutions that have already shown you what they do in emergencies. They don't protect you, they protect the system, so you protect yourself. Now bring it back to that print, 73, 39. Then the whip, that is the market confessing. That is the market saying, under stress, we can't stay rational. And if the silver market can't stay rational, what makes you think the pension system will? What makes you think government promises will? They're all connected by one thing, confidence. And confidence is the first thing to die. So you don't anchor your future to confidence. You anchor it to reality, weight, tangible value, no counterparty. That's the exit. If you want to survive what's coming, You need to stop thinking like the sleeping herd. You need to start thinking like an insider, not an insider with connections, an insider with awareness. Subscribe to Currency Rewind if you want to survive what's coming, because the next time silver prints a number that makes no sense, it won't just be a chart anomaly, it'll be a warning you can't unsee. And one day, soon enough, the system will ask you to trust it again, with your retirement, with your freedom, with your future. Remember this thought when that day comes. A promise is only valuable when it can be kept. And the people running this system are running out of ways to keep theirs.